income investing has been a staple of investor portfolios for centuries. While historically individuals gravitated mostly to traditional fixed income markets like corporate and government bonds, ever since the 2008 financial crisis, non traditional fixed income has become a bigger part of investors' portfolios. So today, Sarah Browne talks about this growing asset class, how it differs from traditional markets, and what to watch out for when considering non traditional fixed income investments for your portfolio. Sarah, good to have you here again.
Thank you so much. Thanks for having me, Patrice. Great to see you.
Thank you. Well, let's talk about non traditional fixed income. When did this really start to pick up, the interest in this?
Absolutely. So you alluded to it in your opening statement there. I think you really started to see this sector evolve following the great financial recession in 2008. If I could take us back to that 2008 crisis, one of the reasons of bank failures was a subprime lending or in other words lending to risky borrowers. So as a result of the catastrophe of this crisis, the regulators really pulled in the reins for banks and they tightened lending standards and this was good for the overall systemic risk of our banking system, but what it did is it restricted bank lending to an extent. So here we have this new sector come into play, and it's created an opportunity for these non-bank lenders to fill in some of the gaps where banking regulations and restrictions have, overcome the 2008 crisis.
What does non traditional encompass?
Yeah, that's a great question. So really it's a really large basket. It's almost like let's define traditional. So in traditional fixed income, we can think of the US Treasury market. We can think of credit bonds, which would be like, a typical company issues a bond. We can think of agency mortgage-backed securities and other securitized products. So not traditional is anything that falls outside of that. We're seeing a lot of private credit related to, real estate. We're seeing insurance-linked securities. We see asset-backed receivables, and we see private credit, which is would probably the largest part of this non-traditional bucket we talk about.
You mentioned real estate, but real estate is where the 2008 implosion basically was centered.
Yeah, no kidding. And so that's why it's really important for us at Foster and Motley and the fixed income desk specifically. We focus on high quality receivables. We're doing all of the due diligence for our clients, and we're making sure that we're checking all the boxes, dotting all the I's, crossing all the T's for our clients.
All right. Talk to me about the differences and the similarities. You kind of touched on it a little bit, traditional versus non traditional.
Absolutely. So let's talk about similarities because there's fewer here. I would say the main similarities are the actual income. So, you're going to typically get income for bonds, or you call it a coupon rate or an interest payment, most likely semi-annually. For these funds or private investments, it's more like a distribution rate. But either way, you're getting some sort of income on a regular basis. This is the main defining factor of fixed income, hence the name. Oh, real quick before I go on to differences. So another similarity here is I think is a common misconception that just because it's in the private sector, it's in non-traditional means that it's lower quality, you
Hmm.
know. That should be addressed because just because it is in a private sector does not mean it's lower quality. In fact, there are just the same, you know, we have strong underwriting in a lot of these funds and a lot of these private credit instruments, and you could see just as high quality or even higher than some of the other credit traditional fixed income out there. And then as far as differences are concerned, one of the things we see is that a lot of the non-traditional fixed income have floating rates and they're shorter duration, whereas traditional fixed income really runs the gamut on duration. You can have short duration, medium term, or long-term duration. And then the next 3 I kinda wanna group together because they all sort of are together. We have lower correlation to traditional fixed income instruments and equity for what it's worth. They also can have lower standard deviation or volatility, and they're less liquid. And the reason why I wanna lump those all together as they're all related in the pricing mechanism. So, okay, so, we have lower correlation to the markets, and in that, we're seeing a lower standard deviation and volatility. These are less liquid instruments, but in exchange for this, we see higher return potential and higher income in the portfolios.
Hmm.
One last thing to note too is the minimum sizes. So it's difficult for an individual investor to go out and find these things. There's often a very high minimum investment, and that's another way that Foster and Motley leverages its relationships with these funds.
Yeah, that was going to be one of my next questions. The individual investor really has a difficult time getting into these, correct?
Absolutely. We're seeing, could be anywhere from 10 million to 100 million of a minimum investment where we can pool our clients' investments together and achieve that minimum standard. It's difficult for individual investors to do that on their own. I will say I think that's another good point that we have the capability, the skills, and the expertise to analyze these as well. So even if you wanted to go and invest these on your own, I think it would be more prudent to allow a professional to handle the actual analyzing of the different funds.
How about pairing up traditional and non-traditional?
Yeah, absolutely. So, one of the fundamental principles of portfolio management is this concept of diversification, right? It's having multiple items in a portfolio with this low correlation that I alluded to earlier. And so that basically we have a smoother return and lower risk in the overall portfolio. And
Hmm.
these non-traditional investments just do an outstanding job of providing just diversification in portfolios. Another thing is that they provide higher levels of income compared to some traditional investments in fixed income. So, like you were saying, like we were talking about, because they have lower liquidity and some riskier aspects, the investor is compensated for this. And so, pairing these with some of the traditional fixed income in the portfolios can provide higher income, and it provides diversification benefits to two things that are, very crucial to have in the portfolio.
And it's some peace of mind too if you're actually paying attention to them.
Absolutely.
All right. Talk to me about holdings. What do you see?
Yeah. So, very broadly speaking, like I said, we're seeing a lot of private credit related to real estate. We have some holdings related to insurance linked securities. So, this is completely uncorrelated to anything in the market. These securities are based off of weather events. So, really has nothing to do with stocks, bonds, or anything. And then we have some asset backed, which basically means you're taking an asset and you are securitizing the receivables or the income from those. Yeah, and then the final one I think probably makes up the largest part of this non-traditional bucket is private credit. So these are funds that partner with other companies that are looking to take out a loan, and then they basically underwrite the loan and they do all the due diligence on that side, and then their fund is a conglomeration of these loans. We're seeing yields anywhere from about 9% to 11% on an
Oh.
annual basis. And so this is typically about double what you'll see on a 10-year treasury as of today's rates.
And what time frame are we talking about with these?
That's a good point as well. We're looking because of the liquidity, because of these other kind of, risks that you don't see in a fixed income market. We put these mainly in portfolios for our clients that have a longer time horizon.
Okay.
So, and I want to make a point to let you know that these yields that I quoted are expected yields. They're not guaranteed. And of course, a credit event can happen. So, it's a measure of total return, which basically means it includes the price improvement and the distribution. So, anything can happen. But right now, those are the yields that we're seeing.
All right. Very good. So, anything else to wrap up here? I mean, this has been a lot of very interesting comparative information, traditional versus non-traditional. Is there something that still needs to be wrapped up here to put a little bow on it?
Yeah, I think we note that obviously the sector's been booming and that it's attracting investors, but we need to be reminded that it's prudent that these investments are looked after like Foster and Motley does. We take a disciplined approach to select funds with higher quality holdings to protect in a downturn. And then that's not the work doesn't stop there, right? I'm taking a look at these on a frequent basis. I'm keeping in mind the trends of the economy, different relative value and pricing. We're looking at other risk measures. So we're making sure that it's not a set it and a forget it sort of thing. That
Mm.
we're making sure that these investments are appropriate for our clients today, tomorrow, and 10 years from now.
All right, fantastic. Sarah, thank you so much. Very, very interesting discussion. And it does seem that non traditional fixed income, along with other investment classes, depend a lot on who is managing the underlying investments and their experience. You can always contact the team at Foster and Motley to learn more about this growing asset class and how to get exposure to your portfolio. Follow this Foster and Motley podcast to know when a new show is ready. And of course, please share it with others. We value your time and thanks for being with us.
Thank you.